Whew. Okay, so now that you know how much debt you have because you went through step 1, kudos to you. First of all, let me say kudos to you for doing the work, okay? Hey my Skye Savers, welcome back to my channel, or if you're new here, welcome. I'm Kim and this is a World of Skye, a world for women and moms to talk all things money, saving money, making money, and managing your money. And today we're talking about the types of debt paying methods. There's different types of methods. There's no like one size fits all for everyone. So we're gonna walk through that, we're gonna break it down, and hopefully you'll be able to find the one that works best for you. Before we jump into that, please make sure that you are subscribed to my channel. Trust me, girl, your purse, your wallet, and your bank account will thank you. Debt. Okay, let's talk about it. Let's talk about the debt. I know it could be overwhelming. It could be frustrating. It could just be downright discouraging if you have a lot of debt. I understand. But first of all, let me say that you are not alone. You're not alone. There are a lot of other people that are in the same boat as you. They're in the same boat as me. They're in the same boat as us, okay? So for debt, we're talking car loans, we're talking student loans, credit cards, personal loans, and any other debt that you have. So first, I'm going to talk about the things that you have to do. You have to do this step in order to organize your debt, in order to create a plan to pay it off. I'm then going to discuss three different strategies that you can use in paying down your debt. So hopefully by the end of this video, you'll find the one that works best for you. Okay, so let's first talk about how to organize things and to find out even how much debt you have, okay? You may not even know the total number of debt that you have. Okay, and we have to have a starting point. You have to have a starting point in order to create a plan and also track your progress. Now, this number can be a hard truth, okay? It can be a hard pill to swallow once you add up all the different debt that you have. And it's okay, but I'm here to encourage you, okay? I'm here to encourage you because you've taken the first step, right? And you're wanting to actually tackle your debt. You're not running from it, you ain't hiding from it. You actually want to tackle your debt. So though this number can be a little bit shocking, it can be a little bit like, ooh, you have to know what your number is. So let's talk about how you're going to do that, okay? So you're going to want to make a list or a spreadsheet, right? It really depends on whether you're like a pen and paper type of girl, you want to write everything out, or if you're more of a digital person, you want to create a spreadsheet on your computer, your tablet, wherever. Either way works just fine. You just need to document and figure out these following things. For each debt that you owe, I want you to write down the following on your spreadsheet or on your notepad. You want to know the debt name as well as the account number. So is your debt with Navient? Is your debt with Ford? Is your debt with, I don't know, Chase, Wells Fargo? Who holds the debt? Who is the lender? Who is the creditor of the debt that you have? Okay, so you'll want to go through and find that information. Write down every single one of those. Next to that, write down the account number, okay? Every account or every type of debt that you have will have a unique account number associated with it. It could be your social security number, but it's probably not. It's probably a unique account number that was given to you, assigned to you by that creditor. Okay, so you need the account number. In the column next to that, you want to put what type of debt is it? Is it a car loan? Is it a student loan? Is it a credit card? Is it a personal loan? List that out next to the account number. The next thing that you want to document is what is the balance of each account, okay? So this is the part that might get you a little bit, okay? But just keep going. You can do it. Remember, think to yourself, I have to have a starting point. I have to know how much debt I'm in. So go through every single account and write down how much you owe today on that account. The next category that you want to tackle, the next piece of information is going to be the interest rate. What is the interest rate? What is the interest rate on this loan or on this credit card? You need to know that information. If you don't have the paperwork from when you signed the loan agreement, contact the lender to get this information, okay? They will be able to provide it to you, and this information is very important in picking the strategy that you're going to use to tackle your debt. The next column on your sheet is going to be payment terms. So how long is this loan for? Is it a 5-year auto loan? Is it a 10-year student loan repayment plan, or is it a 25-year student loan repayment plan? You want to document how long or the term of that loan. And the last thing that I want you to document is what is the minimum monthly payment that you must pay every single month in order to keep your account in good standing. Okay, so is your student loan, your minimum payment, is it $50 a month? Is it $25 a month? Is it $300 a month? What is that minimum payment? Same with your credit card. Is it $35? Is it 10% of your balance? What's the minimum amount that that lender is requiring you to pay every single month so that they can report to the credit bureaus and say, yes, you are in good standing with us this month? Now, you may know where to find all this information. So maybe you still have all of your loan agreements. You should. Bonus. Okay, this is a bonus tip. If you sign up for any type of loan, always keep that information so that you can reference back to it during these times, or if there's some errors on your account. You want to have that original paperwork that you sign, or digitally sign. Make sure that you print that off so you know the term, the amount, so on and so forth, all of that information that we just discussed. But if you didn't keep that information, you don't know where it's at, you don't know where to find it, a great resource is going to be to pull your credit report. And you can pull your credit report for free. Yes. You can pull it for free at annualcreditreport.com. Okay, so I'll put the website right here. Go on there. You're able to pull your free credit report for the 3 credit bureaus. And then you can see what accounts are listed on each credit report. Also on your credit report, it will have the lender's name, but oftentimes it will have their contact information for you. So if you need to contact the lender, you'll have a phone number or a website that you can go to in order to get in contact with them if you need to know more information about your loan, such as the interest rate or any other questions that you may have. Now, make sure that you review your credit report thoroughly, okay? You don't want to leave anything off of your list here. You want to go through and check for any accounts, whether they are current, delinquent, whatever it is. If it's an open account, if you have a debt to these people, you need to put it on your list. I have a whole series on my channel about credit reporting, credit scores, all of that good stuff. So check that out if you're interested in diving more into credit and things of that nature. Also, if you're enjoying this video thus far, please be sure to give it a big thumbs up. It really does help me out. Thank you. Whew. Okay, so now that you know how much debt you have because you went through step 1, kudos to you. First of all, let me say kudos to you for doing the work, okay? Doing the hard work and figuring out all the information, combing through all the information to find out all the details about your debt. Kudos to you. That's a huge step. That's a huge step. It really, really is. The next thing that you're going to want to do is to review your budget, okay? You want to review your budget so you know how much money you have to put towards paying off your debt. If you don't have a budget, you need to have a budget. What you doing, girl? What you doing? You need a budget. So if you need to know how to create a budget, check out this video. 5 easy steps to walk you through how to create a budget that you can use every single month. But in short, you'll need to take your total income, subtract out your total expenses, and that'll give you your discretionary income, or what I like to call just like your leftover money. Now, keep in mind that your budget should already have some or most of your debt payments included in it, right? At least those minimum payments that we talked about calculating before. Those should already be included into your budget. So then with your leftover money, you need to determine how much of that money you want to use in order to kind of expedite and pay off your debt quicker. So if you've done your budget and you have like $500 in leftover money after you paid all your expenses, maybe you're going to decide, okay, for debt payments, out of that $500, I'm going to designate $200 out of that every single month to go towards debt. Okay, that's just an example, but make the numbers make sense after you've calculated your budget. If you've worked your budget and you don't even have any leftover money, okay, there are some things that you need to do. Maybe you need to get a side hustle or a part-time job, or maybe you can use any big amounts of income that you get throughout the year, like a tax return or something of that nature, to help you pay down your debt. Okay, there's options. You just got to implement them. Okay, so now we walked through how much debt you actually have. We calculated your number. We walked through how much leftover money you have each month to put towards your debt. Now let's talk about the different strategies that you can use to actually pay down your debt. There are 3 different strategies that we're going to talk about. So here are the example sample numbers that we'll use for all 3 methods. Hopefully it helps kind of make everything come together and make sense and help you decide what will work best for you. So you have student loans with a total balance of $20,000 at 3%. You have a car loan for $10,000 at 8%. You have credit card number 1 at $5,000 at 27%. And credit card number 2, $3,000 balance at 19%. So the first method that we're going to talk about is the snowball method. With this method, you're going to pay the smallest debt first. So you're going to put all of your debt payment extra money towards that smallest account. But you're also going to be maintaining the minimum on all your other accounts, so you're keeping those in good standing. Then once you're done paying off that debt, you're going to take all the money that you were paying towards that debt and start paying it on the next smallest debt that you have. So you're taking everything that you were paying on that smallest debt and you're kind of just building on everything. That's where like the snowball method name comes from. So let's use numbers. Let's make it make sense. But keep in mind, you are still paying the minimum on all your other debt, okay? In this example, credit card number 2 is your lowest debt at $3,000. So all of your extra debt money payment that you've designated, which was $200, all of that money is going to go towards paying off credit card number 2 until you have it paid in full. Once you have paid off credit card number 2, what you're now going to do is take the minimum payment that was due on credit card number 2 plus that $200 that you were paying and start paying that towards the next lowest debt, which in this example is credit card number 1 that had a balance of $5,000. Okay, so let's say the minimum payment on credit card number 2 was $50 plus your extra $200 debt payment. Okay, so you were paying $250 a month towards credit card number 2 until you got it paid off. Now you're going to take that $250 a month that you were paying towards that and start paying it towards credit card number 1, which has the $5,000 balance. So now on credit card number 1, you're going to pay whatever the minimum was on credit card number 1 plus $250 every single month. Okay, so you're building on it like a snowball. The whole point is that you start with the smallest and you build up until you get to the largest. So then you're going to end up paying off credit card number 1. Then you're going to move to the next debt. In this example, that is a car loan for $10,000. You're going to use that same approach. Take everything that you're paying from credit card number 1 and pay it towards your car loan until that is paid off. And then in this example, the last thing that you have is the student loans for $20,000, and you're going to take everything that you were paying on your car loan and put that towards your student loan. So that is how the snowball method works. Hopefully that was explained well and that you understand how that method works. So the snowball method is good for someone who wants to kind of build their confidence while they are paying off their debt. Okay, so tackling that smaller account first, you're like, yes, I can do it. I have the swing of things. I know how this works, and I'm going to keep going. Also with the snowball method, it may seem like you are paying off your debt quicker because you're paying off those smaller accounts fairly quickly. So if that sounds like something that you would need, you want a confidence booster, and you want to feel like you're tackling things quicker, although that may not actually be the case, but it seems that way, then the snowball method may be the best option for you. The second method that we're going to talk about is the avalanche method. This method, you pay the highest debt first or the account that has the highest interest rate first. So in our example, if you are tackling it by amount, and remember, you're still paying the minimum amount on all of your other accounts, but you would pay all of your extra money that you designated for debt towards your student loans in this case, because that is the largest balance at $20,000. So you're going to pay that down until that's paid off. So then you're going to start tackling that next largest debt, which in this case is the car loan at $10,000. So you're going to take what you were paying on your student loans and you're going to put that towards the car loan payment plus the minimum payment that you were already paying on your car. Okay, so it's like the snowball effect, but reverse. Yeah, because you're going to start with the largest balance and you're going to work down to the smallest. With the snowball method, you start with the smallest balance and you work up to the largest. Okay, so with the avalanche method, for example, related to balances, you're going to pay off the student loan, then the car loan, then credit card 1, and then credit card 2. Okay, so now if you're going to do the avalanche method by interest rate, the method is the same, but the order that you're going to pay off these accounts is going to be different. So in our example, you're going to want to tackle credit card number 1 first because it has an interest of 27%. Then you're going to want to go to credit card number 2, which has an interest rate of 19%. Once you have that paid off in full, you will focus on paying off the car loan, which has an interest rate of 8%. And then lastly, you would tackle your student loans at 3%. Okay, so same method. You're going to take all of the money, pay off that one first, and then take everything that you were paying on that first account and apply it to the second account. So on and so forth. The avalanche method is best for someone who is looking to get rid of their biggest debt, okay? So if you have a large amount of, let's say, student loans, $50,000, $60,000, $70,000, $100,000 in student loan, and that kind of hangs over your head, maybe that is a thing that keeps you up at night and you want to get rid of it at all costs, okay? The avalanche method is going to be what works best for you because you are motivated and incentivized by getting rid of your largest debt. That is when the avalanche method would come into play. You don't feel like you have that debt like hanging over your head for forever. And the third method that we're going to talk about is the debt consolidation method. This method combines all your debt. Okay, it takes everything that you owe and you combine it into one account. Okay, just one account. So in this example, you would take your student loans, you would take your car payment, you would take credit card 1 and credit card 2. And then instead of having 4 different accounts, you're just going to have that one single account. And then you just pay down that one account. This method is great for somebody who only wants to focus on one account. Maybe having too many accounts open is distracting for you, it's confusing. If you want to focus on just one account, a consolidation loan may be the best option for you. You could possibly also encounter a lower interest rate by doing a consolidation loan because of the calculation that they do and the averages that they perform. So you could wind up paying less interest over time. If you want to know more about how debt can actually impact your credit score, your FICO score, check out this video where I break it all down. Well, that's all I have for you today. Please make sure that you are subscribed. Thank you so much for watching. I appreciate you, and I'll see you in my next video. Happy saving.